This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name's Alex Perny, as always, and we are very pleased to welcome on today Sean Campbell with Valiant Finance. He's their managing director, and we're going to be digging into a topic we've certainly never covered today on the podcast, which is relating to litigation finance. Now, it's something that I have had some exposure to, and a lot of people have heard the term litigation, lawsuit, tort, all these different kind of keywords, but there's a lot of things that go into it, and one of them is money. And that's kind of one of the big constraining factors of a lot of court cases. You hear people, you have to, pay so much money. You hear about these huge amounts of settlements being paid out in attorney's fees. Well, that just doesn't come out of thin air. The money has to, arrive from somewhere to cover costs and everything else like that. So we're going to get into kind of a really interesting segment of finance when it comes to people investing in and financing court cases. So, Sean, thank you very much for being on with us today. Maybe give us a little bit of background about yourself and kind of how you came to be at your role at Valiant.
Sure. And good morning, Alex. Thank you for having me on. So again, my name's Sean Campbell. I'll give you a little background on myself. So been in the financial services industry for about 24 years now. Back in about 1999, I broke into the structured finance side of things, which, as you and I both know, Alex, that's considered an alternative investment back in the day, and then moved myself over to the traditional capital markets for probably the better part of 17 years or so with the likes of Vice President Morgan Stanley and then Senior Director of Voya Asset Management, which recently this opportunity came about to get me back on the alternative side of things when Valiant came calling and said, listen, we've got a really cool idea and a product that we created, but the one thing we don't get as lawyers is we don't understand how to distribute this. So lo and behold, I came over here as managing director back in May to really get this product, this story out to the public, as this is the first time a product like this will be available to accredited investors.
Fantastic. So let's kind of dig into the very basics, pyramids built from the base up, and then we focus it into a singular point. So, in general, let's kind of define for people what exactly is litigation finance. Maybe let's kind of look at it in the more historical context of what that is, and then we'll branch into kind of, the new ways that this is evolving and how you're involved with it.
Sure. And we'll break down the term litigation finance. What does that mean? We're financing litigation. We're financing court cases. And Alex, as we've talked before, litigation finance can hit every section of the law industry. And what I mean by that is there are companies, law firms out there that focus on personal injury. They need financing for that. There's companies that focus on fighting Medicare. They need financing for that. Mass tort, class action, it can hit any section of the actual law industry. But when I think about what litigation finance truly is, and I walk back to how it started, was, as you can imagine, that good old term finance means that it was started by the banks. So as you had alluded to before, it is not cheap to litigate. It costs money. So a lot of law firms, especially if they're going up against a big firm like throw a Johnson & Johnson or a Monsanto out there. As we know, those big corporations have their own law departments, and they've got a lot of money to be able to fight against any sort of plaintiff. So the law firms decided, we've got to do two things. We've got to band together when we want to fight a big case. But more importantly, we need a pile of money to do that. And that's where the banks stepped in at first when it came to litigation finance. The banks would say, you want $25 million? Okay, I've seen your balance sheet. We're going to loan you $25 million. It's going to be 15% interest, and don't miss a monthly payment. Here's your money. And that money would slide over to the law firm to give them the ability to fight whatever cases they were fighting. The only difference is, as you alluded to as well, is as asset classes start to grow and evolve, innovation hits. And back in the 90s, there was another section of the capital markets that saw litigation finance and said, we've got a pile of money. We want to diversify. Maybe we should be going out there talking to these law firms. That was the hedge funds. So the hedge funds started stepping in solely because it gave them the ability to diversify out their portfolios and find that ever elusive non-correlation to traditional capital markets. So the hedge funds in the 90s started saying, wait a minute, you don't have to go to the bank. I've got a pile of money for you, Mr. and Mrs. Law Firm. Why don't you loan it? Why don't you take that loan from us? And as we evolve again, innovation starts to hit, and truly litigation finance companies as a whole stepped in, where a company was created to specifically be designed to fight or help fight and fund a certain part of that law industry. I'll give you an example of that. There's a litigation finance company out there that will solely loan money to law firms that are fighting against Medicare. Why do they do that? Because as you know, Alex, every court case is not going to be won. So from a finance perspective, if we're loaning money to somebody, we better understand where that money is going and what it's fighting. And if I've got a certain expertise in the Medicare law side of things, it'll give my firm the ability to feel more secure when I'm loaning money to a law firm to fight a certain section. If I'm a litigation finance company that covers Medicare and I've got a lawyer that says, hey, I need a pile of money. I want to go fight somebody that just got T-boned by a trucking company. That litigation finance company is going to say, not our expertise. You got to go find somebody else. And then you step into where we are today. As innovation continued, that's where Valiant stepped in and said, wait a minute. Okay, so this has never been available to the accredited investor before. How do we get and package something that gives the accredited public the ability to be able to invest in this as well? Because again, that ever elusive non-correlation that we all strive to get to help balance out a portfolio, we thought there was a need there. And that's where we stepped in.
Great. So let's kind of start from the beginning. There's definitely a little bit to unpack there. So in the traditional sense, to kind of, again, hit the high notes of that is that, again, lawsuits are very expensive. So law firms in general that would have things like class action, mass tort, and would define a few of those terms, but they would go out and say, hey, we need money to, pay our attorneys, do research, get expert witnesses, kind of package together a lawsuit, a credible fighting chance again to go up against the Monsantos and the Johnsons. But so, they would lend money to a law firm. Now, would these notes traditionally be structured as some type of just unsecured loan to the actual company? Would it be some type of VIG where they'd have to, say, hey, a percentage of the awards at trial will be paid back as kind of, a kicker onto the note as some type of performance basis to that? Let's kind of start of how this stuff, originally got going, because, if obviously the law firm needs money to finance this and they're taking out a note at, let's say, 10 to 15%, that's all well and good, but it's, again, there's an unknown there. There's kind of a little bit of a roll of the dice. So what would be the additional incentive for someone to want to come in and do that? And maybe let's kind of break down again how these things got their genesis.
Yeah, fantastic question. So let me start with the award side first, because that's important. So from a law firm's perspective, based on law, it is illegal for a law firm to share in any of the profits that they receive off of a case. So to your point, I'm a bank, I'm a finance company, and I want to be able to fund and help them. I've got to structure it as a note, a secured note. I can secure that against the attorney fees, but I'm taking a risk that there's a potential that this law firm does not get it right. So that's where the expertise of each individual litigation finance company comes into play, where I'm taking a risk. I better know exactly where that money's going. And in the past, it's always been, I know exactly that money's going to a certain industry in the law side of things, but it never went down to an individual case until now. And I'll explain that in a second. So that was the problem there, where you had a secured note. I handed $25 million over to ABC Law Firm to go fight a Medicare case or Medicare cases. And that's where it ended right there. That $25 million left my ledger, ended up in the law firm's ledger. And as long as they made their monthly payments to me, plus the VIG, the 15% or 12%, whatever the loan was, that's all I'm getting. Very similar to a mortgage, if you think of it that way, from a bank's perspective, is I loaned money and I'm getting money back plus my interest is what makes these banks run. Does that make sense?
Sure. So essentially, the security or the collateralization of that type of loan would be against the potential payout that they would receive. They couldn't and leave it to the attorneys to find a creative way of getting to the point that the banks that they want. Is that the attorneys couldn't say, hey, we will pay into something, let's say, we're just going to say we'll give you 25% of all net earnings from this case. They would have to secure it against saying, hey, if I don't pay and this comes to fruition, then you get a chunk of this. But other than that, it's basically just a fee simple interest note, principal and interest, coming back in, and then it's got a term, it's got a periodization and payment schedule, and they just go from there. So again, that just to kind of paint the picture of kind of where these started. That kind of, is that pretty accurate? more or less?
Yeah, I lost you there for 1 second. Sorry, Alex, it froze up on me, but I think I got the gist of it. So
Yeah.
you're absolutely right. It's a fee simple type of loan that essentially that company is handing over that money, and they've got to hope that that law firm is good enough to actually make that case and win that award. And
Yeah.
that's important. And we'll get into that later, but that's important because you've got a very nebulous investment, if you will. And the matter and the innovation of how this has gone is every firm has gotten a little bit more granular on how we make that predictability actually hit. So we bring the probability up to as high as 100% as we can that this award is going to happen, if that makes sense. We can touch on that.
Yeah, absolutely. So the math guys and all the actuarials really got involved in this one, I'd imagine.
Of
So
course.
if you can for me real quick before we dive into it, I did want you to define a term. It's easy to understand. Liabilities and I think most people understand what class action is. You have a lot of affected individuals that come together as a class that's litigated. Think tobacco. But when you mentioned a term there that I think people might need a little bit of extra light shed on, which was mass tort. Could you give a quick
Sure.
definition of that?
Yeah, and let me give a history a little bit of what mass tort is. So, and it's funny you say class action, Alex, because there are times, including myself, where I will lump class action and mass tort together, and it's not really the case. So, to your point, you defined class action perfectly. Single case affecting multiple people. Mass tort, the only difference is mass tort is going to be multiple cases revolving around the same type of case. Let me give you an example what that means. So, I always like to use something in the news now. Johnson & Johnson created baby powder. They had all great intentions when they created baby powder. Females used it on a daily basis. Lo and behold, there was a negative byproduct to that. We found out that the talc in baby powder created ovarian cancer. So with that, what a mass tort is if a firm is going to go after and sue Johnson & Johnson, like the court case that's going on currently right now on a mass tort basis, you can imagine you've got hundreds of thousands of females that were affected in a different way, each way, by baby powder. Some of them unfortunately perished from the ovarian cancer. Some of them got ovarian cancer, went through chemo treatment, but it devastated their family financially and they can't work anymore. Some got ovarian cancer, were treated for chemo, and were able to bounce back and still live a great life today. As you can imagine, the mass tort side of things means the judge has to award a different amount per whatever the injury was revolving around the same case. So obviously, if somebody perished from this, they're going to be awarded, their family would be awarded more than the person that actually got ovarian cancer, went through 3 rounds of chemo, and today has been cancer-free for the last 20 years. So that's the difference between mass tort and class action, where if I'm one law firm and I'm going to fight 18th year tobacco for that matter, I'm going to have one single award that gets divvied out equally, and it becomes, we've all had that email, were you part of this class action suit? Claim your 56 cents in this check form from Amazon or whatever the case may be. Different from mass tort, where there are going to be different injuries that are being presented, all revolving around the same court case and needing that decision that the judge hits the gavel and says, I find an award to the plaintiffs. Then it becomes, what's the award?
Yeah, I think I got $1.50 from the Facebook settlement. I was like, I guess I was affected. Oh, great, $1.50. It's barely worth the postage sent. Okay, so we kind of understand the genesis of all this. You have law firms saying, hey, I need money. We have these two different kind of main things that we're focusing on, whether it be mass tort or class action, because those are going to be, in general, your largest lawsuits. That are going on. It's not, me suing Allstate or, someone coming out and doing something different. These are massive lawsuits. I mean, you're hearing about hundreds of millions, if not billion of dollar settlements. These are kind of the cases that we're focusing on. And again, we see the need, banks, whenever there's a need for money, people go to banks, they identify it. Okay, great, we're going that direction. So now let's transition a little bit. You mentioned that there were kind of 3 different buckets. One, you have the bank starting out, then you have hedge funds getting into it, and then you have the evolution that Valiant has kind of come in with packaging this as an investment product for individual investors. So let's kind of focus on that middle tranche right now of, when the hedge funds step in. What was kind of the reasoning behind that, and how did that kind of evolve the market?
Sure, great question. So Hedge funds solely stepped into this marketplace because they saw returns higher than the typical federal funds rate. And they also saw the ability that there was no mark to market on this type of investment. Since you're talking about a secured note alone, if they gave 100,000 to a law firm, that 100,000 stayed on the ledger and they were able to make, let's say, the 15%. Most importantly, for a hedge fund's perspective, was correlation. So as you know, every asset manager out there is trying to build a diversified portfolio, just like every individual investor is, to be able to weather any storm, whether it's 2008, 2022, it doesn't matter. We want something that does not correlate. And the funny thing is, in the financial services world, as you know, Alex, there are a lot of folks that will run around and talk about correlation. And they will say, well, this stock isn't correlated to this bond. And the funny thesis is yes, that's right in a normal environment. But when volatility is introduced into the capital markets, everything has a way of correlating to one. So the hedge fund saw this and said, this doesn't correlate. Even with volatility, let me get a chunk of this into my portfolio as well, because it's going to stabilize a little bit. So that's really the interest that hedge funds had in this in the past, was I need something that is not correlated. And that's exactly why themselves, endowments like Harvard that were sitting on money, said this is a perfect investment for us to kind of diversify our assets.
Okay, now from that perspective, was the investment structure basically the same, a secured note kind of going in there? Now, one thing that kind of popped into my mind is the actual note going into the law firm. Was it cross-collateralized at all? Like, let's say, again, from the perspective of the risk profile of this, if a case doesn't, let's say, you lose some, you win some, you lose some. Was the bank just then sitting on collecting their interest? And let's say it wiped out the finances and the law firm went under. Would it be law firms don't really have a whole lot of assets, typically besides, their human capital and, so maybe some Herman Miller chairs. But, how are these things, again, was it, because that to me just seems, relatively risky. You always hear about lawsuits dragging on forever and ever, and, these things are probably going to be paid out at a higher interest rate. So from that risk profile perspective, what additional, and this kind of leads into, what investors on the, again, it's not necessarily best practice to call accredited investors retail, but for lack of a better term, the retail side that you deal in.
Sure.
That risk profile, what additional kind of securities on the back end are there? Or again, is it just you have to be very selective with who you lend these to? You're not going to, the Better Call Saul place down the road and lend them millions of dollars for whatever they're doing. It's going to be, the Morgan and Morgans and the, again, I can't peel off a lot of big law firms on the top of my head, but again, where does this kind of lead into? I think you know what I'm trying to get at.
Yeah, no, very good question. So let me explain to you how it did it in the past, because you're absolutely right. This is a risky investment. In the past, it's been extremely risky. To your point, I better pick the right law firm that's going to win the case. So what banks did in the past was, as you can imagine, how do they diversify out their risk pool when it comes to mortgages? Because not everybody's going to make their mortgage payments. So what they did was they lent to a lot of different law firms to make sure that they mitigated that risk, if you will. They wanted a diversified litigation finance portfolio. So when the ones that didn't win, the ones that did win were able to cover that. But remember, I told you there's always evolution and innovation going on. So I'll speak specifically about how we've taken some of those risks out of the market. And I think it's important to talk a little bit about mass tort first, so the audience can understand exactly what that is. So mass tort, as we defined before, remember there's an evolution. There's stages to mass tort. And what I mean by that is, again, let's pick on one that's going on now, Johnson & Johnson. There are stages in a mass tort case that start from discovery to investigation, all the way up to when that judge hits the gavel and says, I'm awarding in favor of the plaintiff or the defendant. So as you can imagine, in the beginning stages, to your point, these mass tort cases can go on for 9 years. They can last a lifetime. So how in the world can you at Valiant put together a note at 2 years, at 24 months, with the possible 1 year extension, at the longest is being 36 months? That's impossible, Sean, because you're investing in court cases that timelines are 9 years long. There is a step in the mass tort stage that is called post-bellwether, which means nothing to this audience right now, but let me explain what it is. Post-bellwether is when a judge will come out, and it could be 5 years into a case, it could be 7 years into a case. It's at the very end of a court case where the judge says, I'm basically putting the defendant on notice. He comes out and says, every expert witness I've heard from for the last 5 years, that every doctor that has come in here and told me that, yes, talc created ovarian cancer, this is no longer an opinion. We're taking what these expert witnesses said as fact. When that happens, it's called post-bellwether, because now what we're doing is we're sliding into that part of the court case where, hey, I put the defendant on notice. The only thing that hasn't been decided is what's the damages. So in the Johnson & Johnson instance, there's been $9 billion thrown around. We don't know if it's going to settle at $9 billion. It could be $14 billion. It could be $7 billion. We don't know that until the judge basically puts together an award for what we were talking about before, everything from death all the way down to, well, it didn't affect me all that much, and I've been cancer-free for the last 20 years. That is what's called late-stage litigation finance. The reason why that's important, Alex, as far as Valiant's concerned, is that's the only stage that we will step into. So your point before, where there's a ton of cases out there, there's about 12 mass tort cases every single year going on in America that are of substantial, hundreds of millions in awards, billions in awards. About half of them are nowhere near the late stage. They're still in discovery, investigation. They're going through counter arguments. We will, as far as Valiant's concerned, they're not even considered an investment for us. We're only going to that post-bellwether side of things, which is about 6 of them. And we're taking a look and saying, okay, now we get to talk to all the lawyers. All that private information that law firms like to keep close to the vest, well, guess what? We talk to one another because we're in the same court case together. With us, we've created our own ecosystem where the litigation finance company, which is Valiant, is handing those assets over to the finding law firm, which is A&M Law in this instance. We created this own ecosystem to say, okay, when we're all talking, as far as lawyers go, what is the case that makes the most sense today? And I look at these cases very similar to the way you would look at a stock. So with Johnson & Johnson, here's a great example. I want to ask you this, Alex, if you think this would be a buy, sell, or hold on a stock. Johnson & Johnson comes out post-bellwether. The judge says, I see all validity in every expert witness. So basically puts everybody on notice. Johnson & Johnson's lawyers say, wait a minute. What if we create this shell company and we throw it in Texas and bankrupt that shell company and make them responsible for paying this? The judge then immediately comes out and says, we're not going to allow that to go down. That's an injunction. Then Johnson & Johnson throws their hands up and goes, okay, we'll settle for $9 billion. And the judge basically says, no, not so fast. I didn't say the award was going to be $9 billion. If that was a stock and you were looking at on a future basis, would that be a buy, sell, or hold?
That would be risky.
You think so? See, I would argue the other way, because the judge has basically already come out and said you're losing. So in that instance, we know we're coming to the finality. From the perspective of the investor side of things. For the investor side, yes. Sorry,
it's this whole thing is all new to me. So I'm just trying to kind of
very true.
But I get what you're saying.
Yeah. So I would look at that as a buy from our perspective. Well, we want to be invested in the Johnson & Johnson case because, one, it's going to come to a close soon, and 2, it's going to be awarded because we've already gone post-bellwether. I'm not saying that this is the case, but I have yet to find it. And nobody on my team has been able to find a post-bellwether mass tort case in Americans' history that has ever not been awarded to the plaintiff. I will say that again. There's going to be one that happens. At some point, some judge is going to have a change of heart post-bellwether and say, oh my gosh, everything that I thought was fact beforehand, now I'm going to throw that all out and I'm going to award the defendant. It's yet to happen. So that's a big thing for us. It's a risk mitigator because we're in the world of predictability and probability. Is there going to be a black swan that happens at some point? Of course there will be. Hopefully that's not the one we're invested in. Yeah. But that's where our expertise comes in. We've got to be able to talk to the lawyers on that. I'll use a sell, which is Camp Lejeune. Think about Wheel of Fortune. Pat Sajak, you get ready to watch Pat Sajak every night. And right before it, there's a commercial that comes on and says, were you living in Camp Lejeune during this year and this year? Call this 800 number. Let's get you the justice you deserve. That is the big court case that just started on a mass tort basis where the government is being sued for water that harmed the people that lived at Camp Lejeune. When that originally came out, most lawyers piled into that and said, let me find as many people that were affected by this. Why did they do that? Because they thought it's the government, they're going to pay, and the government doesn't want bad publicity, so it's not going to go on that long. There was rumors that started going around the law firm circuits that said the government said, well, we're not going to let this close as soon as you think it will. And we're certainly not going to allow you to get the exorbitant fees you do with every other mass tort case. So the minute you hear that from a Valiant perspective, we're like, whoa, that's a sell. Let's get away from that. One, it's not even close to post-bellwether yet. And two, it sounds like this is going to drag on. Not an investment profile that we're comfortable with. We want to be able to, for lack of a better term, stack the deck in our investors' favor as best we can. And the way that we've decided to do that was to stay in late stage litigation post-bellwether and do it with the ones that we feel the most comfortable are going to close within that 24-month time period. Does that make sense?
Yeah, that definitely makes sense. So a few things before we kind of get into a little bit more of the nuance of where this is going. So we've kind of covered, break it down into the three stages. The banks get involved, the hedge funds get involved, and now retail is getting involved. So from the perspective of the investment side of things, obviously most of the time the law firms aren't coming out, the day before the judge gives a ruling or an award and says, I need money. And, this is definitely, they're again needing to hire expert witnesses. They're having to pay for, man hours or, hours of work that are being done. But let's say, something happens and, someone, the bank or the financial institution or Valiant, they've lent the money out. The next day comes around and the judge is like, oh, it's done. Here, the award, the check gets cleared. What kind of protection, or is it just kind of an inherent risk of saying, hey, we lent this money out and essentially it was kind of a net wash and we lost to inflation? Are there prepayment penalties built into this stuff? Are there, what kind of things protect the investor side of things from something paying out too quickly?
Yeah, great question. And I will start it with this. If we get a court case that closes before the 24 months, I will give you an exact time period that I think it's the most beneficial for our investors. It's 13 months. So let me explain why. So we've already modeled all of this out. And with speaking specific to Valiant, ours is a 24-month secured note at 15% interest per year for our clients for 24 months. If we go the additional 12 months, it's again another 15% for them, all accrued like a CD. But let me explain exactly what that is. Our job in this instance is we've already modeled this stuff out. So if the court case closed tomorrow and we were able to sneak in and be able to get, let's say, another 10 clients into the Johnson & Johnson case before that gavel hit, our clients are happy because that note that should have lasted 24 months lasted a week. We still have to pay by PPM the 15% to our actual clients based on the way that this fund is structured. So the shorter the time period, the better for our clients, because if you think about it from an average weighted time return basis, they're actually making more in that instance. I say 13 months because then I'm like, well, I got to pay you the other 15% for year number 2 as well. So then you actually got 30% total returns in 13 months rather than 24 months. So that's the nuance of that. Let me explain exactly where the mechanics of Valiant steps in, because you made a very good point, Alex, in the fact that these are going on long, and how in the world can you step in late stage if these law firms need money to fight these folks for the last 5 years? They're getting that money from somewhere else. The difference between what Valiant does in this ecosystem we created when it comes to mass tort is this. There are 2 law firms or 2 entities that are fighting a Johnson & Johnson. It's the litigating law firm. It's the law firm that stepped in, and let's say it's the ABC firm, and said, we are going to fight you, Johnson & Johnson, because you created cancer for, call it how many, 200,000 different female individuals, and there needs to be justice for that. That court case started 7 years ago. They got their financing from either a bank, a hedge fund, or a litigation finance company that felt comfortable lending them the money, knowing that that note was going to be much longer than 2 years. Where we step in, and this ecosystem we created is A&M Law is what's called the finding law firm. And what does that mean? The litigation law firm is so busy fighting Johnson & Johnson, let's say the law firm ends. This is not a class action lawsuit. So let's say the lawsuit ends, that gavel hits, and they award $1 million for every single person that was affected by talc baby powder. But ABC Law Firm doesn't have any clients. They've been too busy fighting Johnson & Johnson and didn't have any clients in place. They rely on law firms like A&M Law to be able to find the clients that were affected by Johnson & Johnson. So what ultimately ends up happening is our investors' money goes directly to A&M Law, which finds these folks, these ladies that were affected by ovarian cancer, and then we turn around to the ABC Law Firm and say, you've been busy fighting Johnson & Johnson. How many clients do you have? We don't have any right now because we spent all our time fighting Johnson & Johnson. I got you solved. I've got 1,000 clients that were affected by talc baby powder. What if I hand them over to you and we split the attorney fees 50-50? That's exactly what happens in a mass tort type of industry. You'll have a lead litigating law firm that will fight the case, and then they'll have a bunch of other finding law firms that are funneling up people that were actually affected by this. Because it would really stink for that litigating law firm if they fought this all the way through for 9 years, the gavel hits, and they look back and they're like, wait a minute, we never represented anybody that was affected by this. How are we going to get paid? That's how these finding law firms step in.
Okay, so from the perspective of that, where are, and we can kind of transition into kind of how the nuance on the retail side works out for what Valiant's doing. But so where exactly are you lending to then? You would be lending to the finding law firms in that instance?
Bingo. Finding law firm, which is then going to go out based on our intel and say, okay, it looks like Johnson & Johnson is going to close soon. Every lawyer out there is saying, all right, they're putting their hands up. We are close to a settlement. Let's take this $1 million that we just raised from our investors and let's go fight Johnson & Johnson and find those clients. The people at A&M Law who they're talking to, believe it or not, is the 800 numbers, the marketing companies that are finding these folks that were underrepresented. Because when they turn on Wheel of Fortune and a military person looks and says, yeah, I was at Camp Lejeune during that time period, and they call that 800 number, that 800 number isn't a law firm. What that 800 number is doing is collecting and filtering through to make sure that they have people that they can then sell. Alex, I know this won't hit the rest of your audience, but it'll resonate with you and I because there's a commercial that always comes on when we're watching local TV, and it's called 1-800-ASK-GARY. And for the longest time, before I got into this whole law industry, I'm like, I couldn't figure out. I'm like, is this a lawyer? It sounds like they're being way too altruistic. I don't understand it. And then I realized, no, it's a marketing company that's trying to find the people that were hurt by personal injury that they can then go sell to the Morgans of the world, to the Catanias and Catanias, et cetera, et cetera.
Yeah, it's ironic and interesting that you mentioned 1-800-ASK-GARY because that's based out of the county that I'm sitting in right now, Pinellas County, Florida. And Catania, I believe, is over in Hillsborough County, which is just across the bridge right here in the Tampa Bay area of Florida. So there's something, and not to make a really bad joke, but they are litigating Camp Lejeune. There's to be something in the water down here. So it was teed up too easy. I had to make the joke. Anyways, so, from the perspective, and again, one last question on the structural side of things, from the perspective of the finding law firms, obviously, you have the marketing head. So marketing things like Johnson & Johnson, like Morgan, like 1-800-ASK-GARY, are they funneling into the finding law firms or the initial litigator?
They're going to funnel into the finding law firms because the finding law firms are taking their time. While the litigating law firm is taking their time to fight the case, the finding law firms are taking their time to find the clients for them.
Okay. And then from that perspective, when the finding law firms, obviously, are they just brought in as additional counsel or named parties to the case, or are they just basically turning over the clients to the litigating law firm for a fee?
It's the former. So they're essentially coming into the case as a law firm that is basically contracted with the actual court case. So when that gavel hits, they're part of that. That's what's giving them the ability to share in the fees or the awards for that matter.
Yeah, and I'm assuming that it's kind of it's a relatively straightforward process. They say, hey, we're bringing in X number of people, the amount of awards, whether it's just a blanket award like in a class action or if it's like broken down into like a mass tort thing, it would just be the percentage basis on the awards would be the kind of, what they share in from that, right?
Bingo, 100%.
Okay, cool. So anyways, so we bring in to the perspective of we have a change in the market. Anytime there's a opportunity for people to invest in stuff that is basically, gate kept by the hedge funds and your banks and everything. And it brings it down to and again, using the term loosely, retail side of the investor market. I find that very interesting because anytime that you have the ability to have more diversity, more investment options, I think people as a whole and the market as a whole does better. So now with regard to this, you mentioned accredited investors. So you're putting together some type of, is it a Reg D offering where it's closed-ended? Is it a Reg A? Is it kind of is it treated as an open-ended investment fund? Is it closed-ended? Give us an idea of kind of, the top-end structure of this, and then let's delineate out kind of, how the actual minutia of the structure of these things goes.
Sure thing, Alex. So yes, you hit it on the head. It's a Reg D private placement accredited investors at a 50,000 minimum investment. So to your point, I agree with you. As you start to evolve and innovate asset classes, the more that can get involved, the more efficient an asset class comes. So yes, we're Reg D private placement. 24-month secured note with the ability to extend 12 months, which would mean that we'd have to add an additional 15% return for our clients. Again, back to our further conversation, we're striving to find something that from a court case basis is going to close before those 24 months, because that's where our investors really actually make even more returns. Is I give you your money back plus your interest rates that are already set by the PPM in a shorter period of time than I awarded you. I've basically over delivered and undersold, if you will, and that's what we're looking for in that side of things. So 50,000 initial investment, 24-month, secured by the attorney fees 1.5 times, and then essentially 15% distributions per year for the client.
Okay. Now, from that perspective, are we looking at, when you're putting these together, is the underlying case that's being lent to, is it something, because we have a lot of commercial real estate people on here, is it something to kind of draw some analogies from that? Is it something where you're treating this as kind of a pooled investment fund where you have a little bit to this case, a little bit to that case, or is it more specific to kind of like a real estate syndication for a singular apartment building where the PPM is going to dictate in detail, okay, the performance of markets adjacent to this, rent rolls, occupancies? Is it structured to is each private placement structured to one case, or is it more of a pooled investment fund structure?
Yeah. Great question. So it's so I'll start with this. The note that we've put in the marketplace is a $50 million master note. So to your point, Alex, can it be diversified or can it not? So the way that we do this is I'll take a step back on how litigation finance has evolved. Because remember, I was telling you a lot of litigation finance or notes that were out there in the past were longer. They were 5 years, they were 7 years. How in the world did you get it to 2 years, Sean? Well, we did it because we're late stage litigation finance. That's important from this side of things, because what it gives us the ability to do is go to the marketplace and say we are talking to an RIA or an individual accredited investor or a private equity fund for that matter, institution, endowment, doesn't matter. We can say, okay, you give me $1 million today. And remember, I told you it's a 24-month note. So your 2-year shot clock starts today when I invest the money for you. Now, if I've got $2 million, I can go out and say, based on what my client wants, if they want to fight Johnson & Johnson directly and go concentrated, by all means, we can do that. If you want our two best ideas, Johnson & Johnson and Monsanto, we can do that. We can diversify it out, but it's important to remember that, because the way that the old litigation finance worked is they'd say, well, I've got a 5-year note and I'm trying to raise $100 million. Okay, so Investor one comes in January of 2023, but it takes him 1.5 years to raise that $100 million. That wasn't a 5-year note. That ended up being a 6.5-year note, because their shot clock doesn't start until the entire note is funded. And then the 5-year starts. We saw a huge inconsistency in the marketplace with that. And we said, well, if we create a master note and take down the note, it gives us the ability to give our clients exactly what we said we were going to. You're in a 24-month note that starts when you give me the money, not when we raise $50 million. So a little bit of an open-ended answer, Alex, in the fact that, yes, we can be diversified, or we can go direct with our best court case. If we do diversify, as you know, then the likelihood of me being able to close before that 24-month time period is going to be cut down a little bit, given the fact that I need 2 court cases now to close earlier than the 24 months, rather than just one, which would be our best, Johnson & Johnson or whatever the court case may be. Does that make sense?
Okay, so it's basically so it's kind of a raise to a point, and then you plug into the finding law. Again, I'm just a little confused, and hopefully this.
No, I want to clear it up for you.
You have so again, to use your example, a $50 million raise, and then that is going to then in turn, once you've reached that capitalization of that capitalization mark of the particular investment, then you go out and lend the money? Or is it something where the shot clock starts for the investor, and then there might be, some lag time until the actual funds are lent out. So
Yeah,
again,
let
that's
me
just
clear
kind
that
of a
up for
little
you.
bit of confusion.
Absolutely.
Yeah.
Yeah, so we're closing notes every 2 weeks. So that money will be invested and we will go find those clients based on that court case every 2 weeks. That's the way that it's so there's never going to be money sitting on the sidelines waiting for everything else to come in. That's what gives us the ability to take down that. I'm sorry, Alex, hold on.
It's okay.
Darn dog is too loud. That's what
What's
gives
up?
us the ability to take down that master note and make it a true 2 year time period rather than wait for everything to be pulled in on the $50 million and then go deploy the assets. So we're deploying every 2 weeks based on when we're getting funds in. Does that help clear that up?
Yeah, so you bring in, so an investor comes in into the master note, and then the allocations from there are broken out and then allocated to the individual investor that's come in.
That's correct. So
Okay,
here's a
cool.
prime way to explain it to you. I was actually looking at a specific investor that we had in a court in a note already, $200,000. So what it showed on the investor statement was they invested 200,000. There's no mark to market, so it stayed at principal, remained at 200,000, and then every month they're watching their statement, their accrual go up by a little over 1% because remember it's 15% a year. But it gets even cooler than that because it gave the investor the ability to say, okay, I am representing 75 clients in the Johnson & Johnson case. And then we took it a step further from there because remember I told you that we collateralize this, we secure the note, and it actually showed that his note was secured by 1.53 times based on us securing against the attorney fees. So they will see their initial investment that never moves, the accrual going up, exactly what court case they're in, exactly how many people they're helping in that court case, and then what the note is secured at.
Okay, great. And then from the perspective of when these things eventually pay out in this type of investment structure, is the so it pays out and then the master note indicates like the investor is, a 15% return. Is that just a individual, it's not necessarily like a pref, so it's basically just like equal class of investors receiving in note interest. Again, that's a little bit more of the technical side, but it's something I'm interested in. So you bring in
Yeah.
people as is this LLC membership? Is it limited partnership interest? Which
No, it's that's a great question. I'm fairly certain, I'll get back to you on this, but I'm fairly certain it's considered LLC. It's not limited
okay.
partnership. I know that.
Okay, gotcha. So then it's essentially everything is then in turn. So, okay, I think I understand the actual question I want to ask. When these notes are being repaid, is it going to be interest only or is it P&I?
No, it's everything at once. Because think of it this way: if a client gives me $100,000 today, and we're in September of 2023, by September of 2025, what they're going to receive is their $100,000 back plus an additional 30,000 because they got 15% distributions each year. So almost like a CD that you wait for it to mature, you get your principal and your interest all together. That's exactly what happens. The minute that
Okay.
that case is awarded is the minute that we have the proceeds. But it poses a very good question because I'll get this question a lot, Alex, is, well, I want current income. And my answer to that is, this isn't the type of investment vehicle where you want current income. And the reason I say that is because remember, you're waiting for this award to hit. So if I tell you as a litigation finance company that I can give you current income, I'm obviously not going to pay you 15% because the only way that I'm going to give you current income is I take your money and I start handing some of your money back, and it gives me less to go invest in the court case because there's no funnel that is bringing in proceeds until that case is awarded.
Yeah, so this is kind of a good fit for people that understand, potential larger payouts, high degrees of illiquidity in the underlying investment, but again with a potentially higher return. So to kind of go back a little bit, so with the firms that are actually borrowing this money, are they paying P&I or is it interest only, or is it just a bound note by the maturity date? How exactly are they
Sure.
paying these?
They could be in several different ways. This one's going to be a bound note by the maturity date. So
Mhm.
with the ecosystem that we've created, we've realized that, hey, if we're loaning to said finding law firm, we expect to secure that based on their attorney fees so they can't run away from it once the court case is awarded. But we're comfortable loaning that out and waiting for that award to hit. And then we're pulling everything in from there just so we can then distribute to our investors as well.
Okay. Great. That's fantastic. We're kind of coming up on the 45-minute mark of these.
Sure.
I think we've covered a lot of fantastic content with regard to this. I certainly always like to learn something from these podcasts, and I will certainly mark this one as something I definitely learned quite a bit.
Thank you.
Anything, again, we got a few minutes left at the end of it. Anything that's specific to how these things are structured, anything that we kind of missed that you'd like people to take away from this. And then obviously after that, make sure people understand how to get in touch with you if they're interested in learning more or possibly placing some money into litigation finance.
Sure, absolutely. And I think we covered plenty, Alex. So thank you. I appreciate your time today. I mean, at the end of the day, as a new pioneer in an asset class that the accredited investor didn't have access to, it's exciting. But at times it can be frustrating because most folks will say, well, gosh, it's illiquid. No, that's the reason why we cut it down to 24 months. I don't like illiquidity either. So we've taken this asset class that's been longer in the past and cut it down to 24 months, very similar to a CD, if you will. So we tried to hit every pain point that an investor might have. I'm not getting enough on the Fed funds rate. Okay, well, let's give you 15%. I hate correlation to everything else I have. Well, we've got you covered there as well. So we really think that we fit this nice niche and we're able to say, I know we're new as far as being able to get out there. I know the asset class is new, but what we're investing in isn't. Remember, we can go all the way back to 1906 when the first mass tort case hit against, American Tobacco, when the country decided a mass tort case and let's sue against these cigarettes. Who knew that they caused cancer? But essentially, what we talked about before, we have yet to find that post-bellwether that has not ruled in favor of the plaintiff when the judge says, I see validity in all expert witnesses. Not saying it can't happen. It just hasn't happened yet. So I think we've taken a lot of the risk out as much as we can to make this as safe and as uncorrelated as possible as alternatives have exploded over the course of the last 3 to 4 years. To find us, very simple. Just go to valiantfinance.net. You'll see my ugly mug on there, meet the team, all that. That's where the Valiant family of funds is. You can find my contact information on there as well. I'd love to have the conversation with anybody that has even just a question. I'm always available.
Fantastic. Well, Sean, thank you so much for being on with us today. I know I always like to make sure people know that we appreciate their time. It was great content. I hope everyone that listened got some good information out of it. I certainly like to always learn something, and I think that we brought something definitely new to the table with litigation finance. So with that said, again, everyone, thank you so much for being on with us today. This has been the Alternative Investing Advantage podcast, and have a great day.
Thanks, Al.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.